I'm still having a little challenge with this sharing.
Hello, sir. We can see your screen, sir.
I'm trying to scroll down. It's not. Let me stop the share and do it again. I think there's an issue with this share. Okay. So good evening, class. Sorry for that little interruption. It's because of the internet. My internet connection has not been good. So today we are moving on to group audit. Now, before we start, there is need for me to give you an overview of what group audit is. Now, group audit is the audit of group financial statements. Group audit is the audit of group financial statements in order for us to evaluate the group financial performance. So what we want to talk about is we have different companies. When a group of companies with different subsidiaries, when they come together, then you have a group. Now, but in group audit, what we are looking at the evaluation of those subsidiaries. We call them in audit, we call them components. The aggregation of those components together is what we refer to as group audit. So group audit, I say it again, is the process of evaluation of group financial statements, which include all the component financial information. So before I start, I need to give us some little terminologies that we need to also bear in mind. Now we have one of the terminology we need to talk about is group engagement partner. The group engagement partner is the person that is in charge, or is the team lead that is in charge of the group audit. Is the one responsible for putting in place quality control, is one responsible for issuing the audit report at the end of the audit. So is one that will coordinate all the activities of the group, as well as the component auditors. That is one of the terminologies I just explained. The next thing we need to talk about is components. Components are a set of subsidiaries in a group. So a group can be made up of different subsidiaries, which we call components. So a component is just an aspect of the group. Another thing we need to also talk about is component auditor. We have the auditor. These are auditors that audit the component financial statement. They are the auditors that audit the component financial statement. They are the ones that evaluate the financial statements, and they are the ones that give report on the financial statement. Again, I'll still talk more on that, the relationship between component auditor and group auditor. We'll still talk more on that. Then there's another terminology you also need to bear in mind. It's called significant influence. Significant influence. Now, significant influence happens when you have one of the components contributing to a large extent to the common purse, that's contributing to the entire group in terms of profit. It could also refer to significant influence in group audit to mean the component that is exposed to more risk, meaning that if that particular component is affected, it can affect the entire group. So that is another thing we want to talk about. Then we have the group engagement team. The group engagement team comprises of all the team members that have been assigned to perform an engagement, audit engagement of a group of financial statements. So that is one thing we need to first of all clear before I go on. Now, in group audit, there's one thing we also need to know, that there is a slight difference between group audit and there's a slight difference between the group audit and the okay, let me not say that one. So what I want to say is this: the relationship between the group auditor and the component auditor is something that needs to be defined. Now, for the group auditor, is the one in charge, is the one that will take full responsibility for the audit. It does not, when he's writing his report, it does not say that, oh, because of information I got from the component auditor, hence I was not able to so and so this, or I relied on so and so information from the component auditor. He is not allowed to do so. The only area where he's allowed to do so, if the local law, local legislation permits that he make reference to the component auditor's report or situation or comment, that is when he can make reference to it. Otherwise, he takes full responsibility for the audit. The group auditor also must find a way to evaluate the performance, the competence of the component auditor. The component auditor is someone that will always listen to the directive of the group auditor. The group auditor will evaluate the competence of the component auditor by, first of all, having a meeting with him. We have a meeting with him so that we're able to know, okay, he understands what are the deliverables, what are the timelines for this audit. Then secondly, he also assesses his procedure. How does he want his strategy? Or how does he want to go about this audit? There will be time when the group auditor will say, no, I need to sit in at your opening meeting of your component. He will sit there and also be there at the exit meeting. Why is this doing so? So that he can be able to get one or two information from that audit to know that, okay, this component auditor is competent to act in that capacity. Because at the end of the day, he's one that takes full responsibility of the entire audit. Now, the group audit we are discussing today is well explained in ISA 600 that talks about group audit. That talks about group audit. So now let's look at what is the relationship between the group auditor and the component auditor. Before we go to that, let's look at some of the problems that may face, that may be experienced when you are trying to audit the group. One, there might be components with different reporting dates. There will be another issue with components with different reporting currencies. For instance, you have a subsidiary, you have a component or subsidiary in overseas, and your head office or your group office is in Lagos or in Nigeria. So for you to consolidate the report, you need to be able to get that information from the overseas component, and you need to do conversion on the report. So these are some of the challenges that are experienced when you are going about, when you are doing the when you are performing the group audit. Now, there are certain relationship and communication that needs to exist when you want to embark on a group audit between the group auditor and the component auditor. The group auditor will always give instructions to the component auditor on what he wants to achieve. So he sent this report, he sent his communication in a written form, a document that is called letter of written instructions. letter of written instructions. So there it will state categorically what it wants from the component auditor. So some of the information you have in that letter will be: one, ethical requirements. Is that component auditor fit or qualified to audit that component? Looking at whether he has integrity, whether he has independence, whether there is a conflict of interest. All these issues are what he wants to know. And that he also wants to find out as per that is that how does he want to go about the audit? How he wants to go about the audit, he needs to know. The group auditor is the one that will dictate what he wants from that audit so that he can get or he can make the best use of the information as in form of audit evidence from the group or from the component auditor. So the component auditor will also reciprocate in a letter which is called a memorandum of work performed or work done. The component auditor, when he's responding to the request and demands of the component auditor, he will state that information in a document that is called memorandum of work done or work performed. There he will say how he has been able to comply with ethical requirements, how he has been able to exercise quality control in his work. He will say how he has been able to verify and complete all, verify all the information he has in the financial statement. He will say a whole lot about how he has gone, he has performed the work. Because at the end of the day, the auditor, the component auditor will not be liable except in certain jurisdiction or countries that will make reference to the work of the component auditor. So the group auditor will need to exercise due care, skill, and diligence and ensure that the component auditor delivers on his deliverables, what he wants, his expectation, he delivers on his expectation. Because if you look at what I have here, said, because the ISA 600 says categorically that the direction for the group auditor should give to the direction that the group auditor should give to the group audit is the one that is in charge, that give direction. Is also the one that will dictate the involvement of the component auditor. So those are the things he needs to do. Then that takes us to the stages of group audit. Group audit is divided into 3 stages. The first one is gathering of evidence on the component. So, and one way we'll do that is by using those letters that I made mention, those documents. Letter of instruction and memorandum of work done or work performed. You will need to gather evidence, but that is what you will use. That will, you know, when I talked about the audit circle that I discussed earlier on in our earlier discussion, earlier class, I said in my audit circle you have 4 major sections to do. 1, planning. Secondly, gathering of audit evidence. Thirdly, evaluation and review of audit evidence. Then the last one is reporting. So the bulk of the work lies in the evidence that is able to gather. Because if you don't gather, if the evidence you have gathered are irrelevant or they are not sufficient or not reliable, then it will affect the overall report that will be generated or prepared at the end of the audit. So it needs to be very, very careful. Then the next stage is auditing the consolidation. So a good component auditor and group auditor must understand the international financial regulatory framework. IFRS, he needs to know all of them, especially the ones that has to do with group, business combination. He needs to understand it. He needs to know how to treat intercompany transaction. He needs to know how to treat when there is a sales or transaction between companies. So how do you generate profit when you sell to your component? All those issues are what you need to know. All those technicalities, the component auditor and the group auditor must have ground knowledge of these standards. So when he's done with that, he will now go to the last stage, which is issuing the group audit opinion. Now, before he issues the group audit opinion, he will have consolidated his report. He will have looked at all the information that he has gathered and see that those information that he has gathered are something that will be able to stand the test of time. Because it's not only the group that will be needing that information, the investing public is also there. So when you prepare a report and you know that it cannot stand the test of time, then it can put the auditor into a serious mess, which is called a professional negligence. So he needs to be able to issue a report that can stand the test of time. And where he's not able to get such information, the things he can do are stated in the act, in the standard. What he can do is either issue a disclaimer report when the management are not cooperating, or he can resign, because so many other people are also interested in that information contained in that group audit. So the way and manner in which he handles those intercompany transactions, they are very, very important. Related party transactions, they are very, very important because he has to show transparency. So where transparency is not shown or is not seen, then it becomes an issue. So once he's able to do these able to perform these three stages, then at the end of the day, that group audit will have been successfully done. Hello, class. So far, so good. Do you have any question to ask? Someone should please chat me or send a chat, let me know so that before I move on, because we have a question to treat. Anybody should chat me up, please. Okay, thank you. So I should continue. So, like I said, this is more like a refresher class. Okay. Is the group and component auditor for the same firm? No. Now, what will happen is that in reality, because there is difference between what happens in principle and what happens in what's supposed to happen, you understand? Now, in reality, we are finding a situation whereby the component auditor and the group auditor, they are the same. Now, the issue what can happen when you have that kind of situation is that there will be what? There will be conflict of interest. Because it means that you have this self-interest threat that is affecting your engagement. So the way you can handle that is, one, if the audit firm is a big audit firm or an audit firm that is well structured, then we have different teams for different engagements, which I call the Chinese wall techniques in the last class. It's called Chinese wall technique. You have different teams that are not related, that is, they don't know anything about the other engagement at all. So when you have that kind of structure, that you can have different teams, engagement team, that can work independently without cross carpeting, that is moving from one engagement to the other, then you can go ahead and use you can be the same group auditor as well as the component auditor. But by and large, if it was to be an examination question, you should say that it is not ethical. It should not be promoted. but it happens. So if they say, okay, like I always tell us in the examination, always have a balanced view. So if you give them that one that's not ethical, you can also say, okay, there is a way around it. If he has different teams, different engagement team that will not cross carpet, that will not move from one engagement to the other, then if that is possible, then it is something that can be resolved. And that's what I call Chinese wall technique. Now, the letters, can you explain the letters to be issued by the group auditor and the component auditor? Now, that letter that will be issued, like I've said before, is called letter of written instructions. So it would say what he wants, the demands of the group auditor. He will say it in that letter. He will say what he wants in that letter. What he expects from the component auditor, he has to say it. He will say it in that letter. He will talk about the ethical requirements. He will talk about whether he needs the work of an expert, all those things, how we verify information. All this information are what will be contained in the letter of written instruction. So it's from bottom down. I mean, it's from top down. That is top-down approach. That means it's the group auditor send it directly to the component auditor. So it's top-down approach for the first communication. That's the one that will instruct the component auditor. While the component auditor, we adopt a bottom-up approach by issuing a memorandum of work done or work performed. There is going to say how he has been able to achieve those deliverables for the group auditor. He will be able to say how he has been able to achieve those deliverables for the group auditor. So those two letters, those two documents are very, very important when you talk about, communication between the group auditor and the component auditor. Those two letters are very, very important. Please, you can read more. Because of our time, we can read more on that letter or audit itself. Please mute your speaker, please. Any other question? Any other question? Hello, class. Any other question? If there is no other question, please, someone should just prompt us and say we can continue. Hello, class. Someone should just prompt us that we can continue. Okay. So, another thing we also need to talk about in group audit is what is called joint auditing. Joint auditing. Now, there's a difference between joint auditing and shared auditing. There's a difference between joint auditing and shared auditing. In shared auditing, when you talk about shared auditing, that means you are saying that when you have a conglomerate of audit firms or auditors coming together, or when they come together, only one will be the lead auditor or will be the lead audit firm. And that will take the position, that will take decision for the entire conglomerate, the entire audit team. That is what I'm saying here is that if you have a shared audit that involves audit firm A, B, C, D, only one, maybe it will be audit firm B that will be the lead auditor. So it will be the one that will champion, that will take the position, that will take responsibility for the entire audit. It will be the one that will issue the opinion. But in the case of a joint audit or joint auditing, both of them are jointly liable and they are jointly liable and they are jointly responsible for the audit. So what it means is that where in the other case of shared audit, where I said that one person will take the lead, in this case, both of them will work together on that same report. So when they are presenting the audit report, it will be a combined audit report that will have the signature and the names of both engagement partners. It's not one person that will take that position, take that decision. So it's a combined report. So what are some of the challenges that you face in doing that? One of the challenges that you face in doing that is that when you have joint audit, one of the challenges you face is that the audit procedure of the auditors. It's already on the platform. They've sent this material to us. If you want it, maybe after maybe the moderator will send it to the group again, to the platform. So as I was saying, so where did I stop? So now one of the challenges that you face in joint auditing is that the audit procedure used by two people, two audit firms. Now, the first one might have a different audit procedure, audit plan, audit strategy. While the second one will have another audit strategy. Now, the challenge there is that how to marry the two strategies together to now become a one document. That's one of the problems that you face in joint auditing. Another problem that you face in joint auditing is that to resolve your differences might take a longer time because you are two separate audit firms. You are two separate audit firms. So what it means is that before you can agree, you disagree to agree. So before you can agree on the same position, it takes time. Another challenge that you see with joint auditing is that it is more expensive. It's more expensive. The reason being that one audit firm charges a particular fee. Now, when you now have two combined together, that means it will be what? It will be more expensive than one audit firm handling the engagement. Those are the challenges. So what are the advantages of joint auditing? One is that it promotes competition or competitiveness amongst audit firms. It promotes competitiveness amongst audit firms. Now, for instance, and that's what has been on for a while now. Now, if you go to audit of banks, when you're auditing banks, you know that audit of banks is a 365-day audit. What I mean by that is that you cannot just say you just do audit for a bank for just 1 month. It's something that you do around the year. So what happened in that case is that most times when you have a banking audit or audit of banks, it involves joint auditing. So maybe one of the big four will take one aspect of the audit, then the small, medium audit firm will take another aspect of the audit. Because some of the big four, they don't like to, there are some things that they see themselves as if it's too mundane, it's too pedestal, it's dirty sort of. So they don't want to get themselves involved in all those things. What I mean by that is that those tasks they are mundane, they are no brainer to them. So they would like to do more of strategy. They want to do more on risk management. All those things are the ones that they will do. So they will give those other aspects of it, like vouching. They might give the other part of it to the small and medium audit firms. Why they concentrate on, let's say, if they are using business approach now, so they will focus on the prospect. What are the prospects of this company? Of this bank. What are those likely challenges that they will face in the next 12 months? So those are the ones that the big four will work on. Why the small and medium audit firm will be handling some aspect of maybe the tax computation. That's what they will be doing. So that's what they mean by that. So they will be working together, but in different, because they will submit just one audit plan. They will submit one audit plan. So they have to work together to ensure that the audit plan they have submitted is in sync. Both of them have agreed to work together. So that's why I say it promotes competitiveness. Secondly, it promotes growth for the small, medium audit firms. Because if we say that only the big four should be having their way in Nigeria now, that means it will stiffen the small, medium audit firm. That means they will not be able to, they will not have the room to thrive, to grow. But because of joint auditing now, it has given them a platform or a leverage for them to grow. Then another advantage of joint auditing is that better informed decisions are taken. because they say that two good heads are better than one. Two good heads are better than one. So because of that, a good audit report will be what? Will be taken. So where the other one has the deficiency, the other one will complement, thereby producing a good audit report. So joint audit has come to stay in Nigeria, and with the trend of activities in Nigeria, business activities, it has come to stay, and that is why both the Big Four and the small medium audit firm, they are working together to achieve that purpose. So far so good. The relationship has been symbiotic for both of them. That both of them have benefited from that relationship. That's what I'm trying to say. Do you have any questions so far on what I've discussed? Hello, class. Do you have any question on what I've discussed? In the absence of any questions, someone should just prompt that we continue. Hello, class. Okay, thank you very much. No question. That means we are all good. That's good. So we have two questions here. So, but I want us to look at question 1. Let's see if we can finish this question 1 today, so that for group audit, so that we know that we are moving on to the next topic. So the question goes thus: you are the manager in an audit department of Williams & Co., and you are reviewing the audit working papers in relation to Francis Group, that is the group, whose financial year ended on 31st July 2014. Your firm audits all components of the group. All components of the group, which is that question you asked, which consists of a parent company and 3 subsidiaries: Masco, Roberts Co., and Teapot Co. The group manufactures engines, which are then supplied to the car industry. The draft consolidated financial statement recognizes profit for the year to 31st July 2014 of $23 million, 2013, $33 million, and total assets of $450 million. 2013, the total asset was $455 million. Information in respect of 3 issues have been highlighted for your attention during the file review. Masco supplies some of the components used by Robot Co. in its manufacturing process. At the year end, an intercompany receivable of $20 million is recognized in Masco financial statement. Robot Co financial statements include a corresponding intercompany payable balance of $20 million and an inventory supplied from Masco valued at $50 million. So, required: comment on the matters to be considered and explain the audit evidence that you should expect to find during your review of the audit working papers in respect of each of the issues described above. That's the question. So the question is centered around intercompany transactions, which is intercompany trading. Now, look at the suggested solution. It says the intercompany receivables and payables represent 4.4% of the group assets and are material to the consolidated financial statement. The inventory is also material at 11% of the group assets. On consolidation, the intercompany receivables and payable balances should be eliminated. Like I said, when you have intercompany transactions, they should net off each other or one another. They should net off one another. So leaving only balances between the group and external parties recognized at group level. There is a risk that during the consolidation process, the elimination has not happened, thereby overstating group assets and liabilities by the same amount. It has overstated the group assets by the same amount. Now, if the intercompany transaction included a profit element, then the inventory needs to be reduced in value by the adjustment of unrealized profit. This means that the profit made by Maxco on the sale of any inventory still remains in the group at the year end is eliminated. If the adjustment has not been made, then inventory and group profit has been what? Overstated. What they are saying here is that in most circumstances, subsidiaries or components are not supposed to make profit from one another. That's what they are saying. That's what the strategic solution says. So now they now ask us another question. Comment on the matters to be considered and explain the audit evidence you should expect to find during your review of the audit working papers in respect of each of the issues described above. Now, what is audit working papers? Those are the collection of all the information that the auditor has gathered that he will use at the end of the day to generate a report on the true and fair view of the financial statement that has audited. So those are audit working papers. And audit working papers are divided into two. You have the permanent file, you have the current file. So that is permanent file. You know what permanent file is. Permanent file are those contains those information that are not expected to change within the next 1 year. So all the information you have there are more of permanent in nature. For instance, your certificate of incorporation, article of association, memorandum of association, list of shareholders. These are what are contained in the permanent audit file. Then your current audit file includes information that are related to transactions that occur within 12 months. So you have your draft financial statement is there. The audit engagement letter is there. Any other information that maybe there is a change in the key management staff, those information will be there. If there is a change in the share capital, it will be there. So that's what they mean by audit working paper. So it's more like a compendium of audit evidence that will enable the auditor to form an opinion on the true and fair view of the financial statement at the end of the audit. So that's what we are looking at. Then relating it with audit evidence. Remember, audit evidence is it has 3 characteristics or 2. It has to be sufficient and it has to be what? Reliable. Sufficiency has to do with what? Quantity. While reliability has to do with what? Quality. So those are the things. I just want us to highlight some of those things as well so that we can understand and appreciate where the solution is gotten from. So they said that we should comment on the matters to be considered and explain the audit evidence that should expect to find during your review of the audit working papers in respect of each of the issues described above. So let's go. Audit evidence. 1, review of consolidation working papers to confirm that the intercompany balances have been eliminated. So you need to look at the audit working papers to see that they have eliminated those intercompany balances. Secondly, a copy of the terms of sale between Maxco and Robertsco scrutinized to find out if a profit margin or markup is part of the sales price. A copy of the terms of sale between Maxco and Robertsco scrutinized to find out if a profit margin or markup is part of the sales price. You need to look at if they have made profit between or amongst themselves, which ought not to be so. Then another audit evidence you need to gather is a reconciliation of the intercompany balances between Robertsco and Maxco to confirm that there are no other reconciling items to be adjusted, e.g., cash in transit and good in transit. cash in transit and goods in transit. Maybe they're expecting some money to hit another subsidiary, but that money they transfer from one subsidiary but it's not going to the other one. So that is cash in transit. Then the reverse is the case for goods in transit. It means that a particular subsidiary has bought one goods or expects one goods, but that goods as at the time they are consolidating the report, that goods have not arrived. So it becomes a goods in transit. So you need to be able to reconcile both the cash in transit and goods in transit. Then copies of inventory movement report for the goods sold from Masco to Robertsco to determine the quality of goods transferred. Copies of inventory movement report for the goods sold from Masco to Robertsco to determine the quantity of goods transferred. Now, when there is a movement, when you are transferring goods from one subsidiary to the other, you need to have a document that is called inventory movement report. That will show how many goods have been transferred from company A to company B. So at the end of the day, if one company has not settled, then you know that, okay, because you have not settled, this is how much you balance me. You'll be able to know that. But if you don't have that documented, it will be very difficult. And you know that audit is more of what? Verifiable evidence. So inventory movement register is a source or is a form of verifiable audit evidence. So it will be, and when you have it, that means both parties will sign. When you are transferring, you say, okay, I've signed. Then when you receive, you also sign that, okay, I've received it. There should be an exchange of communication between both companies or subsidiaries. The other thing that we also need to consider as audit evidence is details of inventory count held at Robertsco at the year end. Review to confirm that there are no intercompany goods, that no other intercompany goods are held at year end. So you need to look at, that's the essence of verifying your inventory. At the end of every year, you need to carry out what is known as inventory count. Some companies do it every month end. Like companies that I've worked before, they do it third week of the month. It's very good. While you do that, you'll be able to ascertain the value of your stock, value of your inventory. When you don't do it, when there is pilferage, when there is theft, when there is spoilage, when there are expired products or inventory, you'll not be able to ascertain. But a good company must have a plan in place for inventory management. So one of the things you need to do under inventory management is what? Having a periodic stock count. That will fish out some of those issues that exist in your inventory. It also take care of your valuation. Because if, for instance, if you have a company that is into computer sales now, and you don't carry out your inventory every month, or let's say in a year, by the time after 1 year, those computers that you have in your warehouse will become what? Obsolete. Obsolete doesn't mean that it will not work again, but what it means is that there will have been some newer version of that system. So that value you have in your system, saying that you have it and you can sell it for 500,000, by year end, the value would have depreciated because of what? Obsolescence. That means that there are newer versions. So for instance, now what I'm trying to say in essence is that you have a phone. You have a phone that you bought, or you sell phones. And let's say you have a Techno, I don't know, maybe Techno Spark 4. And you're not able to sell everything by year end. Come January, there's a new phone that is coming out, Techno Spark 5. People don't want to buy Techno Spark 4 again. They want to go for the newer version. Hence, bringing the value of your Techno Spark 4 down. And which you also need to adjust in your books because of what? Because of the obsolescence. So that is what that one is. Then that is how you answer the question. So like I always tell us in exam, when you're answering exam questions, please, you can see how short this what's it called? This case studies or this question is. But at times, you might have a short question that requires you to write much. So you need to be able to outline your point. Outline your point. Let it be legible. Please, when you are writing examination condition, please ensure you take time to write properly. Because some examiners do not have time to look at what you have written. If once they cannot see, they will just cross it. And you have believed that, oh, this examination is perfect. And the result will come out, you will now be, you will be disturbed. So please ensure you write legibly in your exam. Don't rush, don't write legibly that an average person can see. Very, very important. And when you write, ensure you punctuate, observe those punctuations. You know, in English, then when in secondary writing, you see there's one thing they call COIMA. Content, organization, expression, mechanical accuracy. That's COIMA. The same thing still applies here. If you're not able to if your answer does not have content, regardless of what you have written, you will not be able to score good marks. Then the way you organize your answers also goes a long way. You are not able to have enough points, but when you have good organization, it fetches you mark. Then your expression, now you're able to express yourself. Expression is very, very key. Then the last one is mechanical accuracy, that you know where to dot your T's, dot your I's and cross your T's. You need to know. So all these, and ensure that you avoid canceling in the examination, please. If it's possible, please avoid canceling. Don't cancel. Let your paper be neat. In fact, at this level, professional, you should avoid canceling and alteration. Let your answer markings, your answer sheet, let it be clean. If you have made a mistake, you can just rule one line. Don't paint. Don't paint. Just rule one line and go on. Somebody will know that, yes, there was a mistake there. But when you paint, you try to change it, then it might cost you some mark. At professional level, these are some of the things that some of the examiners will be looking out for. So that is that about that. Do you have any questions so far before we move on? Do you have any questions so far? Any question for me? You can try this question when you're at your free time. The question 2, please try it in your free time. Anybody should just tell me to continue so that we can move on. So that we can move on. Anybody? Anybody? Hello, class. Can we continue?
Yes.
Okay, good. So the next one we are moving on to now is, like I said, we just pick out some topics which we feel that these are areas where might be of areas of concern to the institute. So the next one we are looking at now is reporting. Reporting. So reporting is the last aspect of the audit cycle. Like I said, is the last aspect of the audit cycle. So that's the last stage of your audit engagement. That is where you summarize all the audit evidence you have gathered in form of a report, which will be presented to the management. So here we are looking at this topic. This chapter 14 has some other subtopics that we need to look at. One of it is true and fair view. True and fair view. Now, true and fair view is a common phrase in audit. In fact, if you are answering any question in audit and you have not come across true and fair view, then that means most likely you might need to check, am I answering audit question, advanced audit and assurance question? Because most of the question which evolves around the true and fair view. So what is true and fair view? So true and fair view can be said to be when accounts are prepared. Now, let me first of all, we normally we don't separate the two. We don't separate the two. That is the true and fair. We don't separate it. But just for us to understand what I'm trying to say, true means you are putting the correct information. There is no misleading information. That's what it means. Secondly, the fair means that you have presented it fairly in line with IFRS, International Financial Reporting Standard. You have prepared it in line with IFRS, and you ensure that there is a minimal, like I always say, there is no report, there is no financial statement that is free of error. But what you can have is that you might have it at a minimal level. So that is when you want to define it separately, but there is a phrase, true and fair view. So what does it mean? It means that the account has been prepared in line with laid down legislation, standard, laid down regulation and standard. That is one. Two, that it does not contain any misleading information. Does not contain any misleading information. Three, the information contained in that report are fairly represented. Are fairly represented. The information contained in that report are fairly represented. So true and fair view is more like doing the right thing. What you say, what you said is what is contained in that report. That is, your words matches your action. That your words matches your action. That's what it means by true and fair view. So that is that about true and fair view. So the next one we want to look at is audit report. Now, audit report is the conclusion of the audit engagement where the auditor summarizes his report in form of, summarizes his activity in form of a report that will be presented to management. And this aspect is covered under ISA 701, 705, and ISA 706. These are the standards, international standard of reporting that covers reporting. So that is audit report. Essentially, we have two main reports. We have two main reports. We have the qualified report and we have the unqualified report. Essentially, we have two main reports. We have two main reports. We have the unqualified report. Another name for unqualified report is unmodified. Unmodified report, unqualified report, a clean report, clean audit report. They are saying the same thing. Why the qualified audit report could be said to be modified report. Modified report. So now, there is something I also need to point out. The use of English in audit is different from the use of English in English language itself. What am I trying to say? In English language, when I say that you are qualified, it means that I'm passing a good remark about you, saying that you are the best person for that job. That is in English. But in audit, when you say something is qualified, it means that the auditor has certain reservations about the audit engagement that has just been performed, or the audit review that has just been performed. So some of the information that you have under other types of qualified report are disclaimer. You have disclaimer report. So I want to check something first. Sorry, I had to go and put on generator. So you have, like I was saying, so the first one is unqualified report. Now, under unqualified report, there are two types of report that are contained in it. You have the emphasis of the matter and key audit matters. Under the unqualified report, there are two reports that are contained in it: emphasis of the matter and key audit matters. Now, let me quickly explain that before I go on to the other one. Now, emphasis of the matter, what it means there is that the auditor is saying that the report that the auditor has reviewed contains some information which needs to be brought to the attention of the brought to the attention of the users. That could be management, it could be investing public. So he will now say that that information is contained in a note, in notes to the account. For instance, if there has been an impairment on the non-current assets, for instance, now what the auditor is expected to do is that, oh, because of that impairment, he will say that, oh, I'm laying more emphasis on that impairment. So you see how he has dealt with it in a note to the account under, let's say, if it's non-current asset, he will say, okay, non-current asset. Under note to the account, you see where it talks about impairment. So emphasis of the matter does not qualify an audit report. That's what I want us to understand. Emphasis of the matter does not qualify an audit report. So it's just giving you additional information on the audit that has been what, that has been done. So it's a type of unqualified audit report. It's a type of a clean audit report. So you have emphasis of the matter. The emphasis of the matter is also very, very important. And I say it again, does not mean that you have qualified your audit report. It's just giving you additional information on how that transaction or that event was taken care of in the notes to the account. Or if you want further information, you can go to the note to the account, you get that information concerning how they have treated that transaction. The second thing you also need to understand is what is called key audit matters. Key audit matters. Key audit matters. Now, key audit matter is also contained in that under clean and unmodified audit report. So what is key audit matters? Key audit matters are those information that the auditor considers to be what? Very, very important, that he needs to disclose to the investing public on how he has been able and how the auditor has been able to treat such transaction in the audit report that has just been what completed. You get me? Key audit matters are those issues that affect the current audit that is being done and how the auditor has treated those transactions or activities in his audit report. So that is key audit matters. Now, key audit matter, let me throw more light on it because this is one area that I've not seen, maybe they've stated maybe once or twice, but this is one area that is prone to testing. So let me use an example to explain what I'm saying here. Now, key audit matters. So for instance, we all know that Access Bank acquired, they didn't say acquire, all the words they use, they merge, they amalgamated, or they were joined together, they joined Diamond Bank, they now became Access Diamond. Now, if this is the year, I think it was done last year. Now, if it was done, I think this last year or so, or this year. So what I'm trying to say is that if you are auditing it, let's say you're auditing Diamond account or Diamond Bank as at last year before the acquisition or amalgamation of the two banks. Now, there is no issue for that year that there was no acquisition of between the two banks. But the year of acquisition, you have to explain some information, activities that happen in that period to the investing public. And that is why you must have a section in your audit report that is called key audit matters. So for instance, what are those things you are going to discuss in there? We are going to discuss, one, how did you handle the acquisition? How did you handle the acquisition between the two banks? How? So later we ask questions. So one of the things they will ask will be, one, how were you able to migrate the account? How were you able to migrate the account of, the depositors from the old platform, let's say Diamond Bank, to the new platform, Access Diamond or Access Bank? How were you able to do that? So that is how the auditor will now explain that what he did. One, he first of all carry out an integrity check. Now, what's an integrity check? Integrity check are those tests that are being conducted in order to verify the transactions that are contained in a particular activity or an account. So, for instance, how do you carry out integrity test? Now, you move your account from Diamond Bank, you move it to what? Access Bank. You move to Access Bank. Now, there is because these two banks have different platforms. Banking platform that they use. So first of all, you need to check if they are compatible. If they are compatible, that's compatibility of both platforms. Now, the what's it called? The Diamond platform, when it's being migrated to Access Diamond, you need to ensure that if you have 10,000 naira in your Diamond Bank account, when you migrate to Access Diamond, your 10,000 naira remains 10,000 naira. It does not become 1,000 naira, neither does it become 100,000 naira. I repeat, what I'm saying in essence is that when there is a migration between the two banks, for instance, Diamond Bank is migrating to Access Bank. Now, those account holders or depositors with Diamond Bank, when they move to Access Diamond or Access Bank, the amount they have in their account should not change. The amount they have in their account should not change. So what I'm saying is that if you have 10,000 naira in your account at Diamond Bank, when they migrated to Access Bank, your amount, your balance in your account should still remain 10,000 naira. It should not go to 1,000 naira, and it should not go to what? 100,000 naira. That is how you can perform integrity test. They also need to check. You now say that you have carried out an integrity test. The next you also need to say is that in the course of that, you are also able to check the compatibility of both platforms. So that means you'll have involved experts. And remember, I've talked about experts in this class. And if you have forgotten, let me say it again. An expert is anyone that has competence in other aspects, other areas of interest outside accounting and audit. So in this aspect that I'm talking about, the migration, you need the service of a computer engineer. You need the service of a computer engineer. You need the services of other professionals, data analysis, all those people. You need their services. You'll be able to put you in the right line, on the right track, because you are moving millions of accounts, depositors' balances from one platform to the other. I remember when they did this thing initially, they said that if you have a diamond account, your account number, everything still remains the same because of that technicality. But it can't go on forever. There will be a time when they will need to migrate everybody to that Access Bank Diamond, Diamond platform. So these are the things the auditor will explain that, oh, these are the things I check. And that means that there is no cause for worry for the depositors as per their account balances. That is what he will do. Now, another angle I want us to look at these key audit matters is, another thing we need to look at is, one, under key audit matters, look at it in this way. We are carrying out an audit. We are carrying out an audit. Now, when you started, you discover that you have, like, for instance, you have like 50 issues, 50 audit queries that you encountered in the course of the audit. Now, of these 50, you need to classify them. Which ones are the critical ones? So you are able to separate the critical ones from the other ones. So you now have, like, let's say 20. Now, of these 20, which ones are very, very important that you cannot shy away from without discussing them? You now say, oh, there are just 3. So when you narrow down to those just 3, those 3 that you have narrowed down to are what regarded as what? Key audit matters. I hope you get it. So let me recap again. Under the key audit matters, you look at it from this angle. 1, the auditor, when he's doing his audit, when he's on the engagement, he will have gotten like 10, or let me say 50 audit queries, meaning that there are some audit exceptions that he has seen. For instance, maybe they don't sign, there's no acknowledgement of performance on the document, that nobody signs the document when they receive or collect money, or when they prepare a document, they don't sign. That is 1. 2, you can say that the counterfoil not even counterfoil, the bank reconciliation statements are not prepared at when due. Normally, you're supposed to prepare your bank reconciliation statement at the end of every month. But this one that you see that they don't do it at all is an audit exception. So on and on, all those exceptions like that, you now have up to what? 50. Of these 50, which ones can you say are very critical ones? For these 50, you can now say, oh, I can only say maybe 10 or 15. Let's say 15. So these 15, which ones are the ones that they are very, very important that you cannot do without reporting? And that will take you to, like, let's say maybe 5. So of these 15, you have 5. So those 5 that you are concentrating your effort on will form the basis of your key audit matters. Will form the basis of your key audit matters. So let me give us another example of key audit matters. For instance, if you have a client and your client has a contingent liability, that is something that will still crystallize but that has not materialized as at the time you are reporting, but something that you have made provision for that it will crystallize. So now, if that is one of those things that you have highlighted as your key audit matters, the auditor will now go out like this. How did we, that is audit firm, how did we handle this contingent liability? For instance, the contingent liability could be maybe your client is a manufacturing company, and being a manufacturing company, being a manufacturing company, one of the workers, they suffered an industrial accident which led to the loss of a limb or maybe a hand. Now, and that person has sued the company. No, now the company has been able to apply for it, give the person everything. By the long run, because the person is not fit to work again, they disengage his services or his service. And after the disengagement, the guy now got was not happy. He now went and sued the company for what? Professional negligence or for breach of contract. So when he does that now, the company will now say, oh, that means they need to consult their in-house lawyer to compute as per the Factory Act what will be the entitlement to this guy if peradventure he goes to the court and he wins. The in-house lawyer will ascertain that and say that, oh, if this guy goes to the court, these are his due entitlements. So the company at times might say, okay, let's wait, because if the guy is not able to get a good lawyer, the company might gain at the end of the day. But the company will set aside a certain amount as what? As compensation or for entitlement. So that will be as what? As provision. They will set aside as provision. So in case it gets to the court of law and the company loses, the guy will get that amount. But why the company will not release that money, the company will also say that maybe they have a better argument so that they will not pay. So, but they will set a certain amount aside, which is called provision. So that provision that they have set aside, now the auditor will now want to do his own audit. He will now verify. How does the auditor verify that this provision that is set aside is meant for this same person? So this person will now carry on with his own expert. So the external auditor will now use his own expert. He uses his own solicitor to find out, after he has obtained information from the client's solicitor, he will use his own independent auditor and his independent solicitor to find out if truly that verification or that amount set aside is something that is true, that can happen, that will materialize, that will crystallize at the end of the day. He will get a position. So how he was able to verify all this information, the steps he has taken are what is going to state down in that key audit matter when he's trying to explain contingent liability as regards industrial accidents. So that is key audit matter. So these two will come under the unqualified audit report. Now, key audit matter, when it's being expressed, does not say that the audit report has been qualified or it has a reservation. No. Key audit matter is throwing more light on the information that needs to be carried out, will be conveyed to all users of the financial statement so that they have a better understanding of what happened. Now, someone might ask me that what's the difference between key audit matters and emphasis of the matter? Now, emphasis of the matter, when it's applicable, we affect the notes to the account. You must relate it to the notes to the account. But key audit matters, it has its own section in the audit report that it will contain. It has its own section in the audit report that it will contain, and you state how you dealt with the key audit matter in that particular situation. Now let's go back to the other types of audit report. So the other one is qualified audit report. So we have two. You have disclaimer and you have adverse. You have disclaimer and you have adverse. Adverse is the worst type of audit report you can ever get. Adverse is the worst type of audit report you can ever get. Disclaimer will be that, oh, just like when you watch a movie, you see all those movies, American movies, when they start at or when they are done, you see that no animal was hurt in this movie. Even though you saw that they killed some animal, will tell you that there's a disclaimer that nothing like this happened. So what it means here is the auditor has absorbed himself of anything that has happened in that audit report. That is disclaimer. But for adverse, the auditor was not able to form an opinion at all. The auditor was not able to form an opinion at all in an adverse audit report, audit opinion. He's not able to form an opinion at all. That is what happens in an adverse audit report or audit opinion. He's not able to form opinion at all. So now, what are the reasons for qualification? What are the reasons for qualification? There are limitations and there are what? Disagreements. When there's limitation of scope and when there are disagreements. Now, what's the limitation of scope? The limitation of scope will happen when the auditor was not able to fulfill all its audit obligation as regards the audit engagement that is currently working on. The limitation of scope happens or occurs when the auditor is unable to fulfill all its audit obligation as a result of the circumstances or situation that surrounds the audit engagement that is being currently worked on or currently being reviewed. So for instance, if you have an audit, if you have a client and your client just engage an auditor, their year end is, let's say, October 2020, or every October, 31st October, and they know that they need to prepare audit report. They need to close their account and audit their financial statement. And they now employ the services of an external auditor by, let's say, June. Definitely the auditor will have a constraint known as what, limitation of scope, because he will not be able to fulfill all his obligation before the year runs out. Before the accounting period for that client runs out, he will not be able to fulfill his obligation. That's the limitation of scope. Then another one that can happen is when you're supposed to carry out an inventory count and the manager said that no, there's no time for that. You cannot stop operation because of you. You cannot stop operation because of you. So find another way to verify our inventory. So that's another limitation of scope. Then you have disagreement. Disagreement will be in line with, let's say, what the IFRS, National Financial Reporting Standard, that your auditor has used, your management accountant have used to prepare the financial statement, are not in line with the globally accepted practices or globally acceptable accounting principles. So when there is a far cry, a departure from those generally acceptable accounting principles, then you have a disagreement. These are the reasons why you will have qualified audit report. Another one could be that maybe the position the management accountant took is different from the position that the auditor took. So because of that, there's a disagreement. And if you're not able to resolve those disagreements, it will amount to either giving it a disclaimer or giving it an adverse. So those are the instances where you have qualification of audit report. Then the last one before I go for today, for next class, we'll look at the question and we'll talk about current issues, then we'll wrap it up. The next one I want to talk about is material relating to going concern. Now, material relating to going concern is covered under ISA 570, which talks about material relating to going concern. So what this one talks about, before now, it used to be under emphasis of the matter. That is, for everything that you do, the first thing you need to test is the test for going concern. If this company or this your client can continue in business for the next 12 months, that's the first thing you do when you are doing an audit. If you are not establishing the going concern status of that your client, then there's no point doing the audit. Before now, when you have issues with material relating to going concern, it's always reported under emphasis of the matter. But now with the revised ISA 570 that talks about material relating to going concern, it says that you have to create a separate section in the audit report for material relating to going concern. So what are the issues that you have there? The same issues, anything that affects the going concern of the business. Also does not mean that the business is under threat of collapse or going into doldrums. No, it's just to say that these issues, they need to take care of it before it affects the business. It's just for additional information to the users of the financial statement that these are the issues that this company is facing. But the company has been able to put measures in place so that this does not crystallize. Those are the information that will contain in your material relating to going concern. So I will stop here for today. If you have any question as per these two topics that I've discussed so far, because this one I still need to talk about content of audit report. We'll talk about that one. Then when we're done with that, we'll look at the question because this topic is very, very broad. I'll still talk about except for audit reports. You understand? Where you have except for, where you have material uncertainty, you understand? Evasive, pervasive, material uncertainty, and other. We'll talk about everything next class. So if you have any questions on this topic, the two topics, group audit and reporting that we've discussed so far, please feel free to chat me up on the platform. I'll be glad and ready to answer all queries, questions, comments. I welcome everything. So we'll end the class here today. Thank you very much. Mr. Moderator. Hello, sir. Mr. Moderator. Hello. Hello, Mr. Moderator. Prof. Salim.
Yes, sir.
Yes. Are we
Hello,
together?
sir.
Yes. So we'll stop here for now because I know you always tell me that it's 8:45 and this is 8:50.
No problem, sir.
Thank you very
No
much.
problem, sir.
Thank you.
Yeah, okay.
All right. Thank you very much. So take care, sir.
Thank you, sir.
All right. We'll conclude next class.